What's going on, everyone? My name is Nicholas Merton here at Data Dash, and today is November 24th of 2021. Well, folks, I hope you are having a fantastic day wherever you are. And in today's video, I want to talk about a topic or a conviction that we've had for a long time here on the channel. The similarities between the existing cycle we're in here in 2021 in cryptocurrency markets, similar to that of 2013, where we had more exacerbated mid-cycle rallies, mid-cycle corrections, and generally much more volatile swings or moves in the market that threw off a lot of investors comparative to history. But I want to actually flip the perspective here and talk a little bit about the other point of view. What differs this time around from 2013? I think that's not getting talked about enough, as we had this conviction for a long period of time that there were a lot of similarities. A lot of people have now grown to that opinion. But I want to go ahead and talk about one major differing factor that many people don't know about or aren't factoring in that differs this cycle from the last. And I want to share one important message here that I think is important if you're to take anything away from this video as we go throughout it. The important message here is this, that each cycle is going to differ from previous ones. There are similarities, there are ebbs and flows between these cycles, but at the end of the day, this is a unique and new cycle. Okay, so we got that out of the way, but I want to go ahead and talk about the differing factor here, and you guys will start to see the key element here that differs from 2013, as well as other general cycles. All right, let's go ahead and do it. So I want to first start by taking a look at the logarithmic growth curves. And I'm going to make sure I scroll down my screen so you guys can see the full kind of a range of the indicator here, as well as the oscillator on the bottom part of the screen. So generally speaking, this is taking the logarithmic growth curves that we've looked at throughout history that generally showcase ranges of previous resistance or market tops, as well as consolidation periods after those full 80-85% corrections of Bitcoin's price down towards the long-term expanding support line. And what's nice about this is it gives us a very clean oscillator to work with, where we can see, generally speaking, with this model, that we tend to see market cycle tops come up here around anywhere from 0.97 to 1.0 on the oscillator. We can see that consecutively here for the last 3 cycle tops. And now we're well on our way towards the 4th one, right? And we can also see here as well, when price comes down here to the lower range, we can see the oscillator hangs along this low range. We had for the first time really a breach down here in March of 2020 with the macro event that happened back then. I think we all know what that was. So let's go ahead here and talk about the similarities. People commonly focus on a lot of the similar elements here. The consecutive 80% correction or 80% plus correction in price, bringing the oscillator down from nearly 1 down here to nearly 0. We can see the long-term consolidation period, right? Generally speaking, even though Bitcoin did have a slight rally up here, and we will talk about that in a moment, the consolidation period pushed on for a pretty good substantial period of time, more than a year's worth of price action. And then we had a rally here to the midpoint line where price had consolidated around this range. And then we had a correction down here to 0.3. We had a correction down to 0.24, not too far off, and a slow recovery here, signaling that clearly this has just been a mid-cycle correction and we're setting up the foundation for a larger move. But the one big element here that we see that is very different this time around is, first off, the volatility again in the market of these kind of premature swings or recoveries in the market. This was something very drastic and different than any previous Bitcoin cycle, at least from the data science models we have to work with. Right? So that's one major outlier here. Not to mention as well, we not only got here to the midpoint range here, but again, building on that previous point, we basically hung above that range for a multitude of months from February all the way towards April, pushing into early May. Right? A little bit different than last time around, which was much more kind of quick and more corrective in a short period of time. And this will play into really the biggest theme or element we're going to talk about as we look through these data science models. The element of difference here is time. The cycle itself, whether it has these volatile swings or not, is getting longer. These corrections, these rallies, albeit they are significant, they're not as quick as what we saw back in 2013. Not as euphoric and parabolic and dramatic and sell-off. They're much more drawn out over time. And there are decent periods of consolidation, or what people would talk about who believe in the Wyckoff method of accumulation and distribution, right? So again, there's a lot of debate about different ways to view the market, but we can see here, roughly speaking, right? We had, for example, this rally off the lows here in December of 2012, all the way up here towards, here around the midpoint line in April 2013. It's about generally 4 months here, right? Going through January, February, March, April. But if we take a look back here, we can see that we kicked off our rally here in September 2020. We could actually make that a little bit more clear here. We'll go ahead and say it's October, right? If we push up here towards the cycle peak, right? We're talking about November, December, January, February, March, right? That's where, again, we generally in April set in our highs here, right? So we're talking about a multitude more months here for this mid-cycle rally, and especially the rally and the consolidation period, right? We can see that we went from our relative highs here in April of 2013 to our new all-time highs in November 2013, right? May, June, July, August, September, October, November. It's 7 months, right? We set this high back here generally in April. We should be expecting a breakout high here, right? This is, again, the model that everyone's been talking about, this idea that we're going to get a blow-off top here at the end of the year, but we just haven't seen it. Perhaps we're seeing not only the broader trend of expanding cycles, but just generally things are taking more time than they used to, because it's not as easy for valuation to increase as it used to for Bitcoin, right? We need much more liquidity. We need much more institutional interest, buyers in the market. Let's go ahead and continue diving through these models here. Really important stuff. The 2-year MA multiplier, taking the green line, the 2-year moving average, which usually is a good range where we want to buy Bitcoin once price is under the 2-year. It's historically been a good range to buy Bitcoin. But it also takes a 5 times multiple of that dollar value of the 2-year MA and gives us the red line, right? The 5x here, right? The 2-year MA. And what's really great about this is this gives us an idea of when cycle tops might be close. Well, what's different this time around, right? We can see here, we didn't even go above the red line here. Again, not as parabolic and euphoric as the last time around, but at the same time, we were able to hold our range here for a much longer period of time, and our correction lasted longer, and we've continued to consolidate sideways, start building up this higher low, similar to 2013, but over a longer period of time, right? So again, very similar stuff here. Now, this is again a sign here. The good news is that we've still got a ways to go. We aren't at a cycle top, but the difference here is that it's taking more time to set up that foundation, right? We can dive here as well into the Powell multiple, right? Powell multiple, if you actually look at the difference between these kind of heightened ranges here in the Powell multiple, first off, we didn't get anywhere near as exacerbated. This is the daily coin issuance over the 365-day average. So we can see generally, are we, overall for this kind of ratio or this multiple, we issuing more new Bitcoin every single day than we usually do, right? So the multiple value here is on the left-hand side, and we can see that it varies over time. Usually when new daily coin issuance is at an exacerbated level, this is a sign of cycle top, and when it's down here in the green zone, that's time to buy. Well, what we can see here is that between these gaps and stuff in these rallies, right, we can see lots of similarities. We came down here towards the kind of accumulation zone, the low range here for the oscillator, or for the multiple, apologies. And we can see here that, again, we had not only much more distinctive rallies here, right, over longer periods of time, but they reached similar ranges here, right, coming around here at this 2.4 range. But if we look at the gaps between these, we can see January, August, right? So we're talking here about, generally speaking, I'm getting my count right, about 7 months difference between these two. Whereas if we take a look between these two peaks, June of 2019, March 2021, right? Talking about wider gaps here, right? We're going over a year's worth of price action here, right? About a year and a half, maybe actually, sorry, a little bit more than a year and a half, right? So much wider gaps here on these mid-cycle rallies and corrections. Corrections are lasting much longer. Buyers are waiting at lower price ranges, right? Again, momentum stalls for a longer period of time, and as it's returning, it takes a longer period of time, and when things really kick off again, momentum's great, but it's still taking longer, historically speaking. All right, so let's go ahead here, take a look at another indicator here. This is one that's really interesting, the 200-week moving average heat map. Right? What's crazy about this cycle is that we didn't get the hot zone here, what I really call the hot zone. It's basically when you get anywhere from around 12 to 14% weekly increases in price, right, from the 200-week moving average. Right, we see some hot zone here on both of these general kind of this mid-cycle top and then the final top here in 2013 going into 2014. We didn't get that this time around. What we did instead is we had multiple weeks where we hung around this range here with the mid-range here on the overall rainbow chart, right? So again, big difference here. Not as euphoric parabolic rallies, but at the same time, things lasted over a long period of time. We've been actually keeping in this kind of cool range here, accumulating, building up the momentum so that we can, again, probably have another one of these styled corrections that we saw back in early 2021. And that's probably going to lead us towards 100K, set up the foundation again for another mid-cycle pullback, and then really set up the foundation to rally up towards 200,000 for Bitcoin. I think that's what we need to keep an eye out for here. All right. Next up here, one of the few indicators that people constantly talked about as a clear sign that we were in a bear market back in May. And I felt crazy because this was like the only data science model that was out there, and I just like couldn't get down with the idea that we were in a bear market. All the data science models were showing that, no, this is, yes, a brutal correction, but we weren't in a bear market, right? But this is the one that everyone was pointing to because they pointed out and said, Nick, look, we've had the orange line here meet with the green line, right? This is the 111 daily moving average against the 350 daily moving average times 2. Right? That's the pi cycle top indicator. Now, generally speaking, that can be a sign for cycle tops. We saw it back here in 2017. We saw it back here in December 2013. But we also had it during our mid-cycle rally here in March of 2013. And this is again where we're seeing the stark similarities here between the last cycle in 2013, or one of the previous cycles, and the current one we're in. But there are some differences here, right? Last time, we didn't have price, basically remain below the green line for so long, right? You can see here we quickly recovered back above price, got above the pi cycle top indicator, and really started to surge up in a very short period of time. But for multiple months, what we've seen this time around that's different, we're seeing much more similar action to what we saw back here earlier in this cycle. We dip below the orange line here on the pi cycle top, we make it support, we come back up here to test the green line, and then we break above it, and not too far off from it, we hold above it for a period of time, right, multitude of months, and then we close below both lines, right? So this is where we're differing, we're taking longer than usual, and I think what we've got here as a foundation is we're going to make support again on this line as the orange line continues to go up. And what we can do is start to build the foundation to start moving higher. And as this green line's going up, this easily means that we could be going towards 100K, maybe even slightly above that. But I think, again, being at that major 6-digit level, it's going to be a big psychological level for crypto investors. And that's where we could experience, again, a correction below both lines and then a blow off top at the end, right? Not too far off, okay? And last but not least here in the sense of the Bitcoin data science models, we've got a couple other things we want to look at. We can see here the MV/RV Z-score. This is the difference between market cap and realized cap divided by the standard deviation of market cap. It's really interesting when we take a look here again, compared to 2013, much more exacerbated rallies here, right? A lot more parabolic euphoria in the market than beforehand. We didn't reach nearly as high this time around, right? Back then it was around 9 to 10 right here on the Z-score, but this time around we only got up to a little bit under 7. Okay? But lots of similarities here, right? Small bump up here to 2, right? We had that back here in July 2019, here in August 2012. What's the biggest difference? It's the gap of time, right? We can see here, first sizable bump here in the Z-score, August 2012. Mid-cycle top, April 2013. Final blow-off top, November 2013. Take a look at the gap of times between these ones. June 2019. February 2021. Right? And again, I don't think we've set in that third top just yet, right? I mean, whether you're thinking we're going to get it here in the end of the year, as some people are calling for, or Q1, or later on into 2022, as we've predicted with the expanding cycles. All in all, we're seeing that the gaps here of time on practically all data science models are getting longer and longer. And that's because of the way this market is driven. I know I'm beating a dead horse at this point, guys, but it has to do with the credit-driven market that we're in right now, the leverage that's in the system that's driving these similar 2013 style rallies. We shouldn't be having these kind of rallies, but we're getting them because of the sheer fact that there's an immense amount of credit in the market that drives up these rallies, right? And when there's periods of time where people start to sell enough on spot market, it creates a domino effect on the corrective side, liquidating underlying people who are borrowing extra stablecoins or dollars to buy more crypto off of their existing crypto collateral, right? It's a really, really big dynamic shift in how the markets work. And it's completely changed the inflows and outflows that we traditionally see in much more build-up parabolic markets, right? Now, I want to go ahead and talk a little bit about the altcoin space here as well. Because as we're confident here, and we'll take a look at the total market cap as well in a little bit, we really have to keep our eye here on what's going on within the altcoin space. We've talked a lot about altcoin dominance. Where are we within the existing cycle? We don't have as much data to work with in terms of looking back to 2013. But what I do really like looking is at the altcoin season index, which gives us an idea of how many of the top plays in the market, the top 50 plays in the market outside of Bitcoin are outpacing Bitcoin. We can see we're on 53 here, about half the market, and it looks like we're kind of consolidating here, wedging in, looking for a breakout here for altcoins to continue picking up. And I think that's going to be in the metaverse, it's going to be in some DeFi plays making a comeback, and it's also going to come in the form of layer 1 protocols, especially as altcoin dominance is picking up and the trend allowing layer 1s are really exciting. Now, one thing I wanted to talk about today in the sense of kind of the emerging layer 1 plays, as well as some of the innovation being built on top of them in regards to their layer 2 solutions and other protocols, is our sponsor today, Nervos. Now, many of you already know about Nervos as a protocol. We talked about them many times here on the channel. They're one of the many layer 1s I'm keeping on my radar personally. It's just my personal opinion. I really actually like how the protocol is actually going about scaling with having a central knowledge base, right? But outside of this, there's also a really exciting element that they just launched as a recent new project, which is known as Godwoken. This is the equivalent of Nervos' first major layer 2 protocol on top of the Nervos network that roots itself similar to other layer 2 solutions on Ethereum. It roots itself in the central security of the Nervos network. And I really love the idea here of being able to start offering some layer 2s because we've seen there's a lot of layer 1s out there who are trying to build more scalable throughput, trying to build better interoperability. That's a big focus of Nervos, of being able to be composable and interoperable between other chains. But one really big thing here is that most of these new layer 1s don't have layer 2 from the get-go. And I think this is an incredibly smart and strategic move from Nervos' part here. The reason I want to talk about why I'm excited about it is something we've talked about with previous projects we've talked about on the channel, EVM compatibility, right? So you can literally start porting over applications from the Ethereum network. If you're a developer, if you've developed previous smart contracts, or you're trying to build within this ecosystem, there's a lot you can already work with that you can port over directly into a function practically the exact same way on Nervos. But outside of this as well, you're getting a really interesting combination here of interoperability focused tools to be able to actually start communicating and interacting with other ecosystems. So I think that this is really building a solid foundation here for people who want to not only capture a new ecosystem early on, but be able to build applications in a scalable way where gas or network fees aren't going to be getting in the way of doing basic DeFi-based transactions. But that's a big focus here, is to build a layer 2 for DeFi and other killer applications within the cryptocurrency space. Now, if you guys happen to be a developer yourselves, or more realistically, if you happen to be a user within the cryptocurrency space utilizing these applications, and you guys want to get early access to Nervos' Godwoken network, you guys are welcome to check out the article. I'll have a link down below in the description. You can fill in for the whitelist application, or you can reach out to the Discord to other community members and figure out how you can become a part of the movement here. But I really recommend you guys take a look into it. It's really exciting to see more networks preparing for layer 2 early on. This is something that, again, I think is a pretty big advantage, because in the Ethereum network, the problem is that you do have layer 2s, but it's a matter of getting them onboarded, right? Most people are not moving over to layer 2, and layer 1 is still very cluttered. So having this option early on, and also as well adding practically the same benefits you'd expect on a layer 2 with what you'd have on a layer 1, that's going to set up a really solid foundation here. So again, I want to give hats off to Nervos for the work that they're doing here to prepare for layer 2 early on in the foundation of the layer 1 network. So again, really good work. Now, outside of this as well, right? Nervos is one of many other plays that we've been talking about in the sense of emerging layer 1 protocols, the metaverse. There's all types of different trends here that are going to be driving the market forward. And we not only expect Bitcoin to continue climbing higher, we have a price tag by the end of this cycle of $200,000, hopefully sometime by November of 2022. Right? So again, we're talking about having a mid-cycle rally towards 100K, having again another correction probably down to $60,000, right? Maybe coming down to test the previous resistance back in May and make that support, right? Something along those lines. And then we would have a final blow off top in November towards $200,000. And then afterwards, soon after, right, sometime in January, February, we're going to have our final market peak as Bitcoin started to cool down. Some of that liquidity flows into altcoins. Risk-taking is at its peak euphoria for the overall cycle. That's when we're expecting the big double-digit $10 trillion mark in valuation for market cap. And just for perspective's sake, we're at $2.5 trillion right now for total crypto market cap. I have a lot of people I've talked to who have a hard time believing that we could reach $10 trillion by this cycle. They say, Nick, that sounds like it's too much, right? We're already in the late stages of this cycle here. We're about to get our blow off top here within the next couple weeks. Maybe we'll go to $3-4 trillion. What makes you think we're going to 10? Putting aside all the innovation and the exciting things that are going on within the metaverse, emerging layer 1 protocols, layer 2 ecosystems, all the exciting things where there are, there's liquidity, capital flowing to, putting all that aside, just taking a look at history here, right? We can see that from the previous lows back in the last cycle, January 2015, the cycle peak, we had a 36,697% rally over 36 months. We're talking about 3 years. I apologize, I was about to do my math wrong. 3 years of time. This time around, we're asking to have a third of that performance, less than a third, over 50 months. More than 4 years. And you can see generally with the line here, it's a much more conservative ask. It's a longer time, less returns than the last time. If anything, we've seen that this is the case throughout history. It's why I've been driving so hard as of recent, guys, to set conservative time frame estimations. There's so much opportunity here in this market. But the problem is people end up overtrading. They end up tripping over themselves, making mistakes if they don't have conservative time frame estimations. Now, I'm standing by my case that we're not reaching 100K this year. We're certainly not, as some people are still championing the idea, we're not going to reach 98K by the end of November. I'm sorry, this is just not going to happen, guys. But that being realized, there is still a great cycle at hand. We have been bullish on this market even since back in the May correction. We were confident that this wasn't a bear market. One of the few voices talking about this in the YouTube space. And again, I'm one to call when I get wrong calls and I get right calls. But one thing that I think we've really nailed with this cycle, and we've continuously been continuing to rewire our brains on, is that this is going to take more time than most people expect. If you're in that camp, if you can keep that conservative time frame estimation in your mind, I can promise you, the vast majority of the time, you're going to beat out the market. Plain and simple. The longer your time preference, the more likely you are to win in the grand scheme of things. Mr. Market doesn't have as many opportunities to liquidate you, to kick you out on a stop loss, all the tricks of the trade. They can't get you because your time preference is long term. And you're in it for the long haul. Anyways, don't mean to be all too emotional or too dramatic or melodramatic, but if you guys like this topic, please consider dropping a like, consider subscribing and hitting the bell icon. And if you do like this kind of macro analysis, we'll be dropping a new edition of the Dash Report later on this month, in the next coming week or so. So you guys are welcome to sign up there, get a feel for what the newsletter is all about. We've got a lot of exciting things. We talk about crypto, stocks, commodities, Forex. But that all being realized, guys, thank you all so much for making the time. Thank you for giving me the time to ramble. And until the next video, I'll see you all in the next one. Take care, everyone.